nobody wants to pay the tax, especially they've probably put their blood, sweat, and tears in this business, or they risk making this investment, and then to have to pay some of these profits to the government is by far the biggest pain.
I'm curious, guys, what's the biggest frustration when it comes to capital gains tax deferral options? You could talk about the 1031, you could talk about other things, but what's the biggest frustration you guys see for yourself or your clients?
I think without using some of the strategies you're incorporating, the biggest one is paying the tax, right? Right? Even though I will say capital gains are fairly low right now, but
well, let's pause that. What do you mean by low? California is 13.3. We got Medicare tax of about 3.8. We got federal at 20, and that's about 37%, not counting depreciation recapture, which could be as upwards of 40 or 45 or 50. So can you define low for us?
Well, I would say that there's different tax rates, ordinary and capital gains, and capital gains is always going to be lower than your ordinary income. So I'm referring to ordinary income versus capital gains. But
okay, fair enough.
Nobody wants to pay the tax, especially they've probably put their blood, sweat, and tears in this business, or they risk making this investment, and then to have to pay some of these profits to the government is by far the biggest pain. And the 1031 has some advantages, but all we're doing is kicking the can down the road, right? We're just deferring them. So kind of, I like with what you're doing is you're helping get rid of them, which would be much better than paying them, I would say.
What's your biggest frustration with the 1031 exchange?
For me, I'm hesitant to defer taxes to a rate that I don't know what it's going to be. I mean, there's been a lot of talk with the capital gains rate being increased, particularly over people. I just read in the paper today, Biden's floating around the idea if people make more than $1 million, that I don't know if that they're going to have a higher capital gains rate. I don't know exactly what he's trying to do, but he's trying to get rid of some of the advantage of the capital gains rate. So if that passes and you defer it to 1031 to a couple of years from now, you could actually be paying more tax.
Yeah, if you finally take some boot or you finally cash out. Go ahead, Cameron.
No, I was just going to try to take kind of a big, broad picture at this. Is nobody likes paying taxes, right? So really, there's 4 or 5 different ways that you can kind of what we call tax avoidance, whether it's deferral, it's deductions, it's elimination, it's kind of offsetting some of this stuff to different tax brackets, right? And so the space that we play in, Anthony and I play in, is the permanent tax savings. Right. And so a lot of times if you have a big sale of a highly appreciated asset, you look at a charitable remainder trust, or you look at a deferred sales trust that you recommend, are very well versed in. Right. If you have a highly appreciated asset, maybe that makes sense. What we typically do is we want to get somebody over into the permanent tax savings as quickly as possible. And now what you see is with a lot of deferral strategies is people don't have access to those dollars. And so the strategy that we implement is a permanent tax savings where we provide access to those dollars for clients. And what's different, you kind of mentioned it before, you start off by asking kind of, hey, why is this important to wealthy clients? It's important up and down the spectrum, right? Man, you know what? You rewind, 15 years ago, 20 years ago, I was early 20s. I wouldn't say that I was wealthy, but I had some of the same frustrations. My frustrations were nobody taught me about money or how to create wealth. And so by putting money somewhere where somebody has access to it, is now we can kind of talk to people about how money works. And that's probably one of the biggest frustrations that I see with our higher end wealthy clients, is that lack of communication on how that patriarch or that matriarch created the wealth over their lifetime. Is what you see is you see one generation that has been really successful either in business and or real estate, and the next generation doesn't have a clue on how they did it, doesn't have a clue on how to manage money. And so that's where we have really kind of set ourselves apart, is having those family conversations. And a lot of what we do is probably what I would say falls under more estate planning than really anything else, is when you have those conversations, that generational wealth planning, it is all about preservation. So I hope that helps.
Yeah, it does. Absolutely does. And just so you guys know, the Deferred Sales Trust, for our listeners, what I love about it is it provides liquidity, diversification, and the ability to be active or passive. And I like to separate wealth strategies or tax deferral strategies into kind of two buckets. There's like the transactional ones. I call those like the blockbusters. Those are like the Delaware Statutory Trust. Those are like the Charitable Remainder Trusts. Those are like the 1031 exchange. They're typically pretty limited and pretty focused. They all serve their purpose in different ways, but it doesn't necessarily always give you liquidity, diversification, and the ability to be active or passive without having to give it all away to charity. With the Deferred Sales Trust, why I think it's transformational, is it kind of gives, we call it the Swiss Army knife of tax deferral strategies. You can have liquidity, you can have diversification, you can be active in real estate, you can be passive in real estate, you could be in stocks, bonds, mutual funds, you can go into hard money lending. I have a client right now, we did a $2.6 million sale out of Alabama, and he deferred all of his tax, and he's building 72 units. He's in his early 40s, and he's like, I don't want to retire all the way. I also have a really high income, and I want to shift to the second phase of my career, which is multifamily development. So he went from like a marketing business background, and now he's launched his new business. I call it the Go Fund Yourself. He used the Deferred Sales Trust, partnered with it, all tax deferred, to build these units. And on top of that, he's a very high income earner. So he's able to, like a 401k, roll the funds on the cash flow back into the trust, and at the trust level, it's able to expense what it owes to him. Therefore, it's typically a zero tax transaction when it's filing his tax return. On his level, he's lowered his tax bracket because he's not necessarily taking cash flow from the trust. So all of these things are possible. The question is, are you the listener going to get educated and check it out, right? Are you going to get with me, Capital Gains Tax Solutions, or Anthony or Cameron, and figure out for the Infinite Banking Strategy to figure out if it's a good fit for you? I encourage you to do that.